clearly silver is definitely on a spot silver basis outperforming gold. This is not the end of this bull run. I would say honestly, this is closer to the beginning of the bull run because both gold and silver are still very far away from their true fundamental value. But we're also going into a period where we will see, I'm certain, in 2026, we will see much more. I think so, but it's also, the point that you make is so darn interesting because, again, there's another bifurcation that's happening where you're seeing, and this is true, there was a headline just the other day on Great Britain, on the UK, and how people in general are pulling back on these cryptocurrencies. This is just a physical representation, right, of these cryptocurrencies. And yet we have governments and banks and corporations that are going full bore. So what is that bifurcation between the prices of, say, Bitcoin or other cryptocurrencies and what's actually happening, and not just the stocks, but certainly the stocks, Nvidia, to your point, Bitcoin, and yet we've got corporations that are rushing full bore into issuing stable coins and into the cryptocurrency. So there's a lot of division that's happening all over the place, which to me would indicate that we are going to have something similar to what we had in the dot-com bust. And I was just talking to my very good friend, Gerald Salente, who believes that we will see that this coming year, 2026. And I have to agree with him. I think that, and it's going to be much worse than what happened in the end of the 90s because the Fed's balance sheet, now they've pivoted again and they're going to be buying back that debt again. It's really a mess and we're in a very precarious position, which is why you're seeing, I don't know, are the powers that be losing control of gold and silver as witnessed by the spot markets breaking out? Because what we know is a rising gold price is an indication of a failing currency and a looming crisis. That's why they have to keep it suppressed. Why aren't they able to suppress it anymore?
Unlike previous crises, today's environment is constrained by an overextended monetary system. Central banks still possess the ability to create liquidity, but each intervention delivers diminishing returns. Since the post-2008 era, repeated stimulus programs have lost effectiveness, turning monetary policy into what many describe as pushing on a string. Balance sheets are already bloated, debt levels are historically extreme, and confidence in policy tools is fading. Markets sense this limitation. When traditional levers stop producing results, investors instinctively look elsewhere, often toward assets that exist outside the financial system's promises and obligations.
In fact, I was talking about it yesterday. From a pure technical perspective, anybody can do this. You can go on to stockcharts.com for free and you can see it yourself. But there is what's called a 200-day moving average. And so every day they total up where spot gold or spot silver or anything else closes. And they add it up for 200 days and then divide it by 200 and it gives you an average. But that 200-day moving average acts kind of like a rudder on a boat. And if the spot price is a water skier, there's only so far above or below that line that it can go before it comes back to that line. And historically, 10% away from that line is a lot. And so with both spot gold and spot silver, the level that it is away from that 200-day moving average is extreme, though I wouldn't say that it's more extreme than the stock market in general is. And so to have a pullback, and that's really what we've been experiencing, is a consolidation up at that higher level, just giving that 200-day moving average an opportunity to catch up. But could there be a pullback? Absolutely, there could be a pullback. And it would just be a normal consolidation. But having said that, I can also sit here and say there might not be a pullback because markets can stay overvalued and stretched a lot longer than anybody would anticipate, particularly with all the geopolitical stuff that is going on around the world and, and with the US going now and creating issues in South America. You've got a hotbed in the Middle East, you've got a hotbed in Europe, and you've got a hotbed now in South America. World War III in 2026, is that what we're going to see?
Rising gold and silver prices are not random. Historically, sustained advances in precious metals reflect stress in currencies and confidence in governance. Technically, both metals remain elevated above long-term averages, yet their behavior suggests consolidation rather than exhaustion. These pauses allow structural indicators to catch up, often setting the stage for the next leg higher. Importantly, recent strength is not driven by speculative excess, but by physical demand and delivery. This shift signals a move away from paper-driven pricing toward a supply and demand model rooted in tangible ownership.
I think the Fed's balance sheet is much different than it was in 2011. And when you're looking at that debt crisis, it's really funny because today you hear Wall Street talking about it all the time. There's an ad on Bloomberg that comes on all the time and it says something like, well, if you're concerned about geopolitics, buy gold. If you're concerned about an overvalued stock market, buy gold. I mean, they never talked about it, even though spot gold and spot silver has outperformed the stock markets and the bond markets and all the other markets. And you can see that really since 2000, but now they're talking about it. So going back to 2011, the Fed balance sheet still had an awful lot of ramp room to make a difference. So when they first started the QE and all the money, the free money printing, it had a bigger impact. But then they were doing Operation Twist and this and that and the other thing. And every time they turned on these spigots, it moved the needle less and less and less. And now when they do it, it really is basically like pushing on a string. So I think that the markets are very different today. They just don't have the same level of firepower. I mean, they can print however many trillions of more dollars they want to create out of thin air, but it's just not having that same impact. And I would also point out during that period of time that people used their whatever they had in any form, in particularly silver, to get through that very challenging time.
A critical transition began recently when physical gold and silver deliveries surged, particularly in markets traditionally dominated by contracts rather than settlement. This marked a turning point. Price discovery is gradually shifting from derivatives to real-world supply constraints. Such transitions take time, but history shows they can fundamentally reprice assets. As physical demand tightens availability, paper suppression mechanisms lose influence. This is not a completed process. It is still unfolding, but momentum is building. When markets return to physical fundamentals, volatility increases and long-term valuations tend to reset much higher.
I actually do, although I think it's really interesting when people say, well, it's a central bank gold buying that has driven the price, because I would really have to, it should have, if it were a true supply and demand market, then it indeed would have. But central banks started shifting their leasing and their selling in 2005, and then they went net positive in 2010. And even though spot gold and silver has outperformed, it's done it in a super quiet environment where they had a whole lot more firepower. When you're looking at what's happening today, this trend that you just referred to started last January, and I think we talked about this before, where you had the US is typically a contract-driven market, and it's just about trading. It's not about taking delivery. But in January, we took delivery, which could be called a repatriation of both gold and silver. And that started the shift from having the markets, and we're not done with this shift yet, from having the paper markets dictating the global price to your earlier point, having the retail, the physical markets actually driving the price. And we are returning to a true, more supply and demand market. And yeah, I mean, we're not done with that transition yet, but I do believe that indeed it will be the retail public that will be, and the physical markets that will be dictating the price. I don't know that we'll see the conclusion of that in 2026 or 2027. But that started last January. So we're almost a year now into that trend, and it's definitely getting more powerful.
Silver's outperformance relative to gold is not unusual at this stage of a monetary cycle. When inflation accelerates and confidence erodes, silver often closes the gap, reflecting its dual role as both money and industrial necessity. Historically, narrowing gold-to-silver ratios have preceded periods of intense monetary stress. Silver excels not as a speculative trade, but as a tool for preserving everyday purchasing power, fuel, food, and basic goods. Its growing strength suggests markets are preparing for a future where tangible value matters more than financial abstractions.
Clearly, silver is definitely on a spot silver basis outperforming gold. This is not the end of this bull run. I would say honestly, this is closer to the beginning of the bull run, because both gold and silver are still very far away from their true fundamental value. But we're also going into a period where we will see, I'm certain, in 2026, we will see much more rapid inflation, which will erode the confidence even more. But typically, yes, that ratio, that gold to silver ratio, gets more narrow, and it was extreme. And so we do see silver outperforming gold, bringing that ratio into more, I guess, normal levels. Having said that, that is quite typical of what happens before or as we are entering a hyperinflationary phase. Once that hyperinflation is even more, if people are more aware of it, then that ratio will grow a bit more, a bit wider, because gold is the primary currency metal against which governments do those overnight revaluations. And I see that being set up, the revaluation trade. I definitely see that being set up. But what silver really performs well is in maintaining your status quo, so that I can always buy that pint of strawberries or that gallon of gas. And so I don't really look at gold and silver as a trade. And when they're at their fundamental value, which for me is somewhere around 40,000 on gold and somewhere around 2,000 on silver, you're not going to want to convert it back to dollars unless you are going to immediately convert those dollars or euros or yen, wherever you are in the world, into a then undervalued asset, right? And we'll need to see how everything shakes out, but that's where the opportunity really lies. Because what gold and silver are supposed to do and have performed for thousands of years is the single most important thing is to maintain your ability to purchase the same goods and services over time. They're to hold their purchasing power value. And while everything else is going to fluctuate up and down and has been targeted for reflation, like income producing real estate or even stocks, right? All of that inflation is going to be burned out, because when we talk about how overvalued technically not fundamentally, but technically gold and silver are, well, stocks are even worse, right? And bonds are even worse. And you know that because they're calling for lower interest rates. And whenever they're calling for lower interest rates, what they're actually saying is that this stuff is overvalued and we need to take its value down more. And guess what? There are well over 4,800 currencies they're all overvalued, right? They only have any value at all because if you trust them, and this is monopoly money. What in the world is the difference between this and this? Confidence. And guess what? This currency doesn't buy you anything anymore. So there's absolutely no difference between monopoly money and this fiat money. There's no difference. So rapid inflation erodes that confidence even more. And I think we will see this year in 2026, that confidence keeps kissing the bottom support. I think we will see it break through that as the rapid inflation picks up because it keeps testing it. And there's only so long that it's going to test that bottom before it breaks through. And once it breaks below that number, then for me, that's when the hyperinflationary clock, the visibility of it starts to really, that clock starts ticking very, very loud. And I think we'll see that in 2026 because we keep testing in 2025. And that only happens for a certain period of time before it does indeed then break below.
All fiat currencies ultimately depend on trust. When inflation rises faster than wages and savings, that trust weakens. History shows that confidence erodes gradually, until it doesn't. Repeated tests of monetary credibility eventually fail, triggering rapid repricing across economies. Gold and silver are not meant to be flipped for profit. They exist to preserve purchasing power when confidence breaks. As inflation pressures intensify and valuation excesses unwind, these metals reassert their role. What lies ahead is not simply volatility, but a profound reassessment of what money truly represents.